Hello, everyone. 147 other nerds have nothing better to do but talk about factor risk management on a Wednesday afternoon. This is only thing between me and a day at the Waste Management Phoenix Open tomorrow. So, let's have fun. Just to give a quick preamble, um, I learned about factor risk management the hard way of making a bunch of mistakes and moving from a tiger cub to a risk management firm and thinking I knew what I didn't really know. I felt like I had some degree of like understanding of it after investing in that context for 4 years. And then at some point last year, I started seeing these things on LinkedIn from a rich Falk Wallace. And I'm like, damn, this is like I thought I knew this stuff, but this is like really well done, and started becoming kind of an avid reader and subscriber and learned a lot, and kind of interestingly speaks to Rich's genius that he can go mega viral on LinkedIn tweeting about factor risk management. It's got like 150,000 followers. So that's so I became, kind of quickly reached out to Rich and I think we become friends. Are we friends? It's like,
For sure, for
brothers? Are
sure.
we friends now?
Yeah, I don't know if we're brothers, but we're friends. Yeah.
Yeah. So, incredible respect for what he puts out there and what he's built. We'll kind of I'll let Rich walk through his own background, but he walked the walk as a fundamental equity analyst and PM, is now building Arcana, which is becoming a well-known risk factor and factor risk management tool. We're not here to sell you anything today. Though Rich has become my partner in building a factors for the fundamental investor program. This isn't going to be a commercial. If you want to learn more about that, you can find that on our website at fundamentedge.com. One of my goals is to try and find some of the smartest people in the world in these different areas and encourage them to be teachers and give back to the next generation of investors. So I'm incredibly grateful to have Rich's participation in that. With that 2-minute preamble out of the way, we will get right into the meat of it. Basically what we're going to do is just have a conversation. I looked through my notes, 10 questions for Rich, kind of walk through his background and some of the areas. I'm sure some other questions will emerge. But one of the things we really want to do with this session, which we'll try to keep to a tight 60 minutes, is give you the opportunity to ask any questions you have about factor risk management, factor risk models. You can either direct those to me or obviously the kind of core expert today is Rich. So thanks for being here, Rich. Really grateful to have this hour with you. Maybe you want to just start kind of walking us through your background in a little bit more detail, particularly focusing on curious what led you to the transition from fundamental investor to quantitative risk model builder. When people talk about exit opportunities from the hedge fund world, they don't usually think about risk model entrepreneur.
Yeah, that's true. But yeah, cool. I'm glad to be able to do this, and obviously excited to do the course. Yeah, the my basic background. I spent my entire career on the investing side. I guess I started in investment banking. I was really focused in college on distressed debt for some reason, maybe analogous to the risk model space in some ways, but just became super into the world of distressed debt and every piece of the bankruptcy code and all the pieces there. And so I started my career in investment banking at JP Morgan in restructuring, went to a distressed debt hedge fund called Silver Point, which is it's like a super fundamental oriented PE style like diligence process, or at least close to it, in distressed kind of debt. Then I ended up kind of, for various reasons we could get into in a separate conversation, deciding equity long short was a more attractive kind of area to be in, and migrated to Viking, and then ultimately was a portfolio manager at Citadel. I covered materials partly from that distressed experience where I covered all the coal bankruptcies that happened in 2014, and ended up covering materials across a few different places. But that entire span was very like fundamental, deep value kind of oriented. And then obviously, as you change between those types of institutions, there's a different horizon of investment, different type of portfolio construction, different number of names in the book. And then ultimately, yeah, have always had we can get into the, I guess, maybe broader about the transition some other time, but have always had this sort of entrepreneurial bug in me to some extent. And I'd done a ton of statistics in college and been very kind of deep on all those kinds of things. And so as I sort of got into the world of risk models and thought about all of that, I do think, again, another topic we can get into later, but this is where the world is headed in so many different ways. Like the whole world is beginning to sort of synthesize like the risk model view of the world with this fundamental stock picking view of the world. And I think in some ways, like phrasing it in a maybe off way, like if you sort of have the understanding of how people pick stocks, at least maybe you don't have the right answer on every stock, but at least you have sort of an understanding of that. That's You've sort of combined that with the factor space, which has an R squared, maybe of 50-ish% of explaining stock movements. Together, you sort of end up with like 100% of what drives at least equity markets at an aggregate level. So all those and many other factors kind of led to the decision.
What was your, it's kind of a long track record of Tiger style investors moving to the multi-managers. It's kind of a well-trodden, like dangerous path because there are some adaptations required in the approach. What was that transition like for you? Like, how did you have to change your investment process? What new learnings were required? Maybe given your kind of stats and quant background in college,
Yeah.
easier than mine coming from my ASU finance degree, but I'd be curious to hear more about that.
The reality, and this maybe goes further afield from like risk models and how they're constructed and where they, which we can get into some of that too. But the reality is that there's kind of two different. I always think there's two different kind of aspects to understanding what factor models do and how they're used and what you kind of the way you kind of approach it. There's kind of the functional knowledge of like, okay, I have a set of exposures, I have a set of risks, I have a set of limits. Like, what do I do with that? And then there's also the like under the surface, like what, how are they built? How do they work? What are the puts and takes underneath the hood of that? Like, there's kind of always the like, how do I use it? And so the reality is the risk model using firms, there's often the kind of key commodity that they're looking for is, alpha or outperformance or single stock kind of, what's, edge or value or whatever. And so it isn't like you're going like a stats background practically is making a huge difference if you're going to a more risk managed place versus versus just a fundamental deep value place. There's tons of practical changes like how many stocks you have on in the book and how they're netted and what you balance A versus B and all the details under the hood there. But like the pitch, I think from a lot of places is that you don't have to change your fundamental process in a lot of ways, and that like we're just going to take that and just sort of refine it, in some sense. We're going to take we're good at picking stocks, and let's find a way to, sort of turn that into the component of that good stock picking that has to do with idiosyncratic type bets, not factor type bets. And so I think for a lot of people, the idea, whether it's from the idea from the firms or the idea from the people, but is let's just sort of transform that underlying stock picking into its X factor piece, So I don't think, so that's at one level of the question. At a second level, yeah, there's this whole new world of stuff, right? Which is like, why did I make money? There's factor pieces and what's a factor and how does that kind of fit in and what's this IDEO number? What's this volatility number? All of those kind of things, are obviously like things you literally don't ever think about in most cases historically, by the way, in a Tiger Cup style world. Now, today, even like you said 10 years ago, if you said you worked at a Tiger Cub, like you would have never had any sense for what a volatility or an IDEO number was. Yeah. Today, if you're leaving one of those places and you're at some seniority level where you're raising capital, it's literally the first question. I mean, maybe it's the second question, but it's in the top 5 questions that you'll be asked from capital allocators, from anybody, which is, hey, how did you generate your returns? How much of that came from factors? How much of that came from idiosyncratic risks? How much of that came from each of those pieces? And so, there's part one, which is just, hey, we're just trying to take a good stock picking and refine out the factor pieces, basically. On the one hand, on the other, it's this whole world of awareness and detail and data and logic that you're kind of exposed to.
Yeah. That's helpful. And you said this is where the world is headed. Maybe just like, what do you think are the biggest drivers, what's driving that secular shift towards greater adoption of factor awareness in investing?
Yeah, it's a really good question. There's lots of different ways to answer that. The there's a few different ways to answer that. So one, there are the drivers that are like proof points of performance, and they're the drivers that are the underlying like causes of why this actually drives good performance, at a firm level. So in terms of the track record, like what has happened is at some level, at some point in the history between 1974 when Bar Rosenberg wrote the paper and today, it sort of jumped from a theory of risk management and factor kind of risk management in a sophisticated, what's called like fundamental equity factor risk models. Not people have thought about. I always say this too, which is people thought about factors at some level from day one of investing, right? Like, what am I exposed to? What are my bets? Like, I'm long this kind of stock or that kind of stock. Obviously, at some level, anything that is any group, as some of our speakers have talked about, is a factor. But the modern world of factor risk management started basically in 1974 when this guy wrote a paper that talked about using fundamental equity factors to manage risk and looking at things in the cross section without going too far down the rabbit hole there. But somewhere between that theory of the world, which is just sort of a sort of academic paper, and today, it jumped from, hey, this is a great idea by an academic, to this is actually incredibly potent in generating really attractive Sharpe ratios and risk-adjusted returns for at scales of tens or hundreds ultimately of billions of dollars in aggregate, and even more in gross. You're right. And so the real secular driver is that people have proven that there is the ability to at scale with capacity and generate risk-adjusted returns, managing to a risk model like this that actually proves itself out to be very effective and accurate in the context of drawdowns, through cycles, through all kinds of things. So that's one direction that has caused that. The second is just that it's true, right? Like that these models do characterize a part of the investing landscape that is buyable for free, so to speak, right? So like, and this is in our first week presentation that I put together. I talk about this, but like, a factor is ultimately, in one framing of it, a benchmark, right? It's what is the sort of academically, theoretically perfect benchmark for any stock at any moment in time. And there are great benefits to any benchmark, which is that it's free, right? But there are imperfections to benchmarking, right? Like if you're if you're long some big steel stock, I cover materials, and Nvidia is ripping, you're like, how could it be fair to put my steel thesis against a benchmark which includes Nvidia, right? This just seems so non-comparable. I wasn't doing any work on Nvidia. How could my underperformance or outperformance have been a function of something on which I couldn't control, right? So at some level, a factor in the sort of like factor decomposition world of things is a benchmark. That's all it is. It's just a better, more theoretically better, academically better benchmark. And so as passive has become just ever more prevalent everywhere, from pension funds, like the ultimate capital distributors, right? The people who own capital or distribute it, are in charge of distributing it. Increasingly, that availability of that passive or factor or benchmark exposure is just constantly on everybody's mind in a way that it might not have been. The other piece is, yeah, so that's maybe the biggest driver. Also, there's just the math of pairing and the ability to say, hey, am I being really intelligent about my distribution of risks? Like in the old model, there might have been enough alpha where if you just had an idea on one side of one leg of a pair, that's enough, right? Or there's enough alpha there. There's enough, great opportunities that you don't need to leverage appropriately. You don't need to kind of be efficient about that. But as the world has gotten, a lot of smart people attack this stuff, and a lot of people work really hard in a very systematic way, and they have great resources and they have great kind of tools to attack this stuff. The world becomes less inefficient, and as the world becomes less inefficient, alpha is more scarce, and you need to just be able to kind of lever it more intelligently or crystallize it more intelligently, kind of. And so, both on the market neutral side, where it's already kind of won the battle, and then in the long only space, it's the same question. There it's more explicitly a benchmark. And there you want to understand like what drove the differences from it, all those kinds of things. In some ways, the long only world is closer to the neutral world in some ways in thinking about this stuff. Not there's overlaps and imperfections in that, but in some ways, the long only world is a market neutral against a benchmark. You're just short one half of the trade is, you're sort of everything is against that, and it's overweight, underweight, right? Really. And so, and then there's sort of this group of net long hedge funds like Tiger Cubs, value oriented funds, others that are kind of in between and trying to figure out where they land relative to all of that. And so, and not to keep going on to that one question, but like the other thing that's interesting is like, in some ways, this battle has been won in the back office. Maybe that's the way to say it, or won somewhere in the organization. One at the CIO level, one at the risk manager level, one at the performance attribution level. Right? Like again, if you go, anybody test me on this, go raise a fund. Like the question number within the first couple questions you'll get is how much of my return was generated by factors versus residual or idiosyncratic or stock specific type return. Certainly, if you and that's true probably even in most cases if you're doing a long only fund, but certainly if you're in any kind of hedge fund structure, they'll want to break down under the hood of relative benchmark like factors and idiosyncratic or whatever. So it's one there. If you're in a firm, like the exposure of risk models somewhere in the organization is pretty prevalent now. Like all of these models are kind of there, have their tentacles in lots of places. Most major long onlys, most major net long hedge funds, neutrals have some exposure to have, if not more than some exposure, have like a department that cares about this stuff. What is the most changing about this that is interesting to see, kind of having circled from the investor seat to this seat, is the secular trend is pushing this to the front office, is where the PM, the analyst, even certainly the CIO who runs the fund, is deeply aware of this. And I think it's like a natural progression, right? Like if everybody else is looking at this stuff and you're getting evaluated on performance and have to raise capital on the basis of it, and it really does characterize a real version of my differential versus benchmarks or versus like, then of course the front office, or I shouldn't say the front office, the investor team wants this at their fingertips. They want to be smart on it. Again, even if they don't fully manage to it or limit themselves to a vol number, their goal is to be, again, if I'm being held to it, if I'm being paid on it, if I'm being all those things. So maybe a long-winded answer, but that's kind of how I think about it.
Yeah, it's super helpful. And I kind of use like the fun metaphors of like, I've met two types of PMs who go from fundamental seats to risk model seats. You have the rage against the machine crew who's like, this risk model's stupid, I'm going to redline it.
Yeah.
It stocks the way I want to. And then you have the RoboCop crew who's like, all right, I'm going to really learn and embrace this
Totally.
and adopt. Can you talk a little bit more about what you see in terms of managers who really adopt that RoboCop mentality and use this as a tool rather than a constraint?
Yeah. It's a great point. And I'm not of the opinion that like the rage against the machine person is bad, so to speak, like in your terminology. Like that's not a bad thing. Like there are flaws to risk models. There are, like, every risk model is flawed. Sometimes there's so many different analogies I use for this stuff, but like sometimes I analogize like the different risk models to consensus. Like, one is the Goldman, one's the Morgan Stanley estimate. And like, sure, as a starting point, it's a good starting point. They're great. They make great estimates, as do risk models, right? But is it the end all and be all thing? Like, is your job, you might have a difference from that. You might say, hey, this model is stupid. Like if you look at Twitter ever, but like, and that diversity of opinions about it, right? Like that, like, hey, this could be better. I disagree with that. Like, that's fine. That's like that's a market, that's what they say, as they say, like, that's what makes a market. And so I don't think there's anything wrong with I don't think it's like, I don't think that it's like, hey, the person who hates the models, the person who loves the models, one's going to die. It's happening either way. Like the world is already kind of there in many ways. So it almost doesn't, matter. But you raise a really great point, which is, and I talk about this a lot because we interact with like PMs at pods and long onlys and Tiger Cubs and everything in between all the time. And for the person who's what you call the RoboCop or whatever, like the most intense about the stuff, they are using it on a like front-footed way, like a sort of offense, not defense kind of concept. And they're not doing it from the perspective of, hey, I'm way deeper on, like how the factor covariance matrix, they'll be like loosely aware, like, okay, I get how there's like a half-lifing, and I get there's an exponentially weighted moving average, and I get that how loosely a factor covariance matrix kind of pieced together. But it's not like they're like deeper or out nerding, as you phrase it, like us on factor covariance structure, right? They're developing a really like functional, useful knowledge of like, oh, okay, here's what's being missed when this kind of happens in this IDEO pair, or they're looking at pair trades through the lens of what's the pair performance on a residual basis. Like that's a super common one from that, from that intense person is, okay, instead of looking at this just A versus B price, what's the residual return A versus B price, or, and then people go way down the rabbit hole of all kinds of things. It's like a really clean example in some ways, or like what's pair residual correlation, for example, or, and again, people go, and I point this out to our team all the time, but it's like, at the functional level, people like get way smarter than me. You know what I mean? Meaning like people go and not just smarter, but just in so many different directions that, are weirdly effective. Sometimes they're like, you're like, where, but so the point is like, there's this infrastructure of separating out factor versus idiosyncratic return. And that's the big secular thing that's winning. And then there's these, sort of interaction points. Like, how do you manage to a model? Like, there's like, obviously anybody who covers stocks knows like tech versus momentum versus quality are three separate factors. But obviously, like if you're deep on these stocks, like there's probably some trend going on in high quality tech stocks that have been outperforming, right? Like, which is like the interaction of those three terms that essentially no real risk model would capture, because it'd be too unstable. It'd be capturing too many things at once. We get into the details of why people might not want to go all that rabbit hole, but there's pure idiosyncratic ideas like, hey, I have a view on earnings that secularly changes the trajectory as people perceive it about subscribers or A or B or C or whatever, right? But and then there's the like rigorous math that we'll talk a lot about in the course, right? That is really important to understand. About like how risk models are built and how they work together. But then there's like this kind of in between space, which is, well, which is how those guys use it really functionally, right? Which is to make money, not just kind of live in a risk model context. So, that's kind of like at least the first thoughts on that question.
Yeah. And I don't think it's that controversial at a multi-manager to understand this concept, right? I get 50 managers, isolate them down to IDEO. That can be 3 to 5% returns, right? I get them that pure residual return, lever it up, turn 3 to 5% on gross into 15 to 20. That's the alpha machine concept of the multi-manager, right? Which is very successful, arguably better, an emerging mousetrap, right?
Yeah.
I was scrolling through the 178 attendees, and we have a lot of Fundamental Edge alumni from family offices, single managers from 500 million to 5 billion.
Totally.
Which have historically, I think it's less of a super clear value proposition to adopt this sort of quantity risk model framework. What would you counsel those analyst PMs on the call who are at a family office or single manager? Like, why? Because one is like, if I become more constrained to just IDEO, my total return goes down, right? Unless I'm willing to apply more leverage. What would you counsel them in terms of kind of thinking about adopting their process, particularly with this interface on factor risk management?
So, there's two or three frames, and in a funny way, the two different types of investors almost use factors in an opposite manner. So there's the world of pods, as you point out, that is neutralizing against factors, levering up to IDEO, and because idiosyncratic returns, vary approximately on average, with caveats galore, but are normally distributed cross-sectionally. Unlike factors, which are extremely not in a time series sense, are extremely not, like, as everybody knows, like markets are very far from normally distributed in a time series sense, but cross-sectionally within period are pretty close to normally distributed, and so the consequence of that is you have this ability to manage volatility if you take lots of breadth really intelligently. So that's the way that lots of pods use it, as you point out, right? Is like kind of this eliminate factor bets. But on the long only side, And so whether it's long only or some other kind of unique setup, whether it's like a family office or, like in the long only side, people are, again, like using the factor framework as a consistent kind of performance decomposition framework, as a consistent tracking error framework. And so there's two different, I guess, vol for a long only is really tracking error. It's relative to the benchmark. It's not like just absolute dollar vol, and they aren't levering that number, right? Like levering in some ways, you could think of it as like levering just increases the required precision or accuracy or truthfulness of these models, right? You just have lots more risk, to any incorrectness in the model. But the way the long only world uses it is in a couple different verticals. So like one is just being really intentional about what your factor bets are. That doesn't mean that like this is something you are trying to hedge out or eliminate at all. It's more like, hey, I actually want to be long growth factor, or I don't want to be long, high volatility or low quality or residual volatility. I want to be long value stocks and growth stocks, and that's like a theme I have a view on that. I look at how those factors have performed, and if I'm going to be long factors, I should be intentional about it. Like I'm making bets, and it sure looks like a lot of my return is driven by those bets, and so and actually a relatively smaller portion in some cases is driven by the residual piece of that, and that's fine, right? If that's the kind of exposure you have, and just being able to break that down, right? Which is, what am I betting on? Why am I betting on it? Do I like that bet? And to kind of be intentional about that. So that's one, and then maybe on the long only kind of that view of the world, it's no less important though to be able to break down A, what factors you're betting on, and B, either for those factors or for the residual return, what drove the performance that you had. And that's where factors can be also really helpful, is just on the performance angle, which is, again, it gives you this really clean like separation of concerns, as they constantly talk about in factor literature, which is what, is it like within residual return, is it hit rate driven? Is it sizing versus selection? Is it, slugging rate? Is it, did I make it on earnings or outside of earnings? Those kinds of analytics are very challenging to do if you haven't had any kind of separation, at least. So like, if you just had like, did I make money on earnings? Like, well, what if the market was up 3% that day? Or, what at the most basic factor is always the market factor, right? So like, but like, you want to be able to look at anything under the hood of, okay, within residual return, what drove, like, did I make money on earnings or outside of it? Did I make money on sizing or selection? By sector, and all those kinds of breakdowns are much more easily kind of performed once you've separated out the returns of both a stock, of a book, into those factor versus idiosyncratic pieces, and it creates like a clean sort of structure. And it's worth mentioning too that while and I think the commercial model providers, I think if you're a quant, you're kind of out there, you're like, oh well, it could be better at this, that, and as a risk person who uses these all day long, like if you're using some of the risk model, commercial model providers, you're always finding a way to be better. Just like a fundamental investor is always looking at consensus and sell side, being like, hey, the Goldman model misses A, B, and C all day long, right? But of course, it's actually a good starting point compared to, depending on what your starting point is, right? And so, under the hood of that, it's just the case that you can kind of look at it in a couple different ways, I guess, is the way to kind of pause there.
Cool. That sounds great. Well, that's roughly 30 minutes. We have 4 questions in the chat, and I would give anyone a nudge for any other questions. I think I may drop in if other questions come to mind. I only got 6 of my 10 questions, but I'm guessing there will be some better questions from all of you too. So let's start from anonymous attendee. I have a question on what actually happens as a PM, sub PM, when your factors get out of whack. For example, your IDEO gets lower than the threshold and you're too exposed to growth or momentum. How do you practically manage positions, noting fundamental upside, risk reward, then also factors, then also keeping an eye on drawdown? It's a great question.
Yeah, great question. Yeah, so there's a few different ways people handle that. So one is, basically there's an art and a science piece to that, which is you can sort of look at optimization, which is to say like, okay, minimizing for change in my positions. What set of trades would get me to the most neutral position relative to where I've started? Or let's say I'm below, like there's a 75% ADO threshold at the firm I work for, or 70 or some, or 80 or whatever it is at the firm, or 60, places vary. But if you're below that number, you could just kind of use an optimizer to say, hey, what's with least change gets me to there? And then that'll give you a set of suggestions, basically. And different firms have different optimization. Some places don't have an optimizer, some places do, everything in between. But basically, it'll give you some degree of suggestion. And then ideally, you can sort of tweak that, be like, okay, I liked all these 10 ideas, but I didn't like this other idea. Let me kind of tweak that, see if that gets me closer to where I want to be. So there's a whole field really of portfolio optimization, all the way, again, starting from even earlier, like probably the 50s, actually. There's a whole set of theories, and then layering on top of factor risk management, there's a whole optimization kind of theory. So that's one. The other is just like various tools. I mean, we're obviously, build tools that do lots of these things, which is like, okay, let me screen the universe of names I care about. Let me screen the whole world, every stock in the S&P. Let me screen for like what stocks have high momentum but low growth, or what stocks have, would balance my factor risk, that way. So it's really like a search there's like a give an answer and then tweak, and then there's also like search widely and add and kind of iterate around that. So that's one thing. Also, there's some processes at firms where they'll like just on a practical matter, they'll like auto hedge you. So like they'll put on factor baskets. That's a big part of this. We talk about it at some points in the interviews for the class, but there's banks put together factor baskets where it's like, oh, this is a momentum basket of stocks that replicates roughly either very precisely or very approximately momentum risk. If that's your issue, it'll just some firms will start hedging you out of that. There's a whole like different firms will have different like sort of waterfalls of procedures if you're falling out of those limits, is kind of the short answer.
And I think it depends a lot on firm culture too. Other firms are more strict about
Definitely.
those provisions than others. Others are more flexible. As a PM, it's an ongoing productive dialogue with the risk team, with your CIO. I'd say generally though, the rule is if you step across the red line with the risk police, you better be right. If you are running too low of an idio and then you blow up, that's generally more problematic than if you're running a tight book. It's seen as a little, certainly if you kind of do that continuously, I've always heard this, it's seen as a little bit irresponsible. From time to time, you'll hear a story about an internal PM violating some sort of risk provision as reason for termination. So it doesn't happen a lot, but I have heard situations.
And the reality is just there is a diversity, like there's really a wide range. There is a range at even like what you might from afar think of as very similarly situated firms. There's some places that do things very similar to one another, and some places that do things very differently. And again, even in the capital raising world of things, there are people who are like, hey, I'm not that focused on it. As long as it's within the range, like as long as somebody's in the 50, 60 idio, let's say, or something like that, I can go hedge that out on the back end. I can do that. Whereas other places take great pride in people being in the 90 idio, whatever. Not that everything's about idio or that way. There's nuances about all that. But there are again some firms that say, hey, they really take pride in being very tight with meaning high idio, and other places that are like, hey, we really don't. We can go hedge that in the background if there are people who are making great P&L and have, we're fine to kind of take that in. And so whether that's pools of allocator capital or whether that's pods, both have a range actually.
Yeah. I just found too, it's like this is one of the things that's a process for me is like I might be running 80 idio. I cover 3 shorts because they worked, and all of a sudden my idio is 65. And I'm like, oh crap, I need to have a plan. And so part of like becoming risk literate is like understanding those dynamics that if I have one short that's really helping my risk and I want to cover that, I need to, from an idea generation perspective, have ideas moving through the pipeline that might be a replacement for that. And so I think that's part of what the best PMs in these models do is they kind of never really go super far out of range, at least the firms I've been at, because they always kind of have this continuous flow of new ideas that where they've considered the risk profile of the individual names. That was one piece of advice a PM gave me after I struggled with this. So I will pass that on. I will pass that on to you.
And again, like I think people have different, like there's it's hard to find people who make, market neutral money, like, forgetting all factors, right? Like dollar neutral. It's hard to find people who make, consistent or even just not that consistent money. So, firms, if a PM has found his way of making money in that context, there'll be a little more, people try to work with people. Again, it's a conversation often with risk departments and things like that.
Yeah. Many firms will give you different risk deals depending on, question from Chad Meir, one of our guest speakers in the program from the DuPont Foundation. Hello, Chad. He wants to know, can factors be timed? Is alpha generation via factor rotation as repeatable of a process as idiosyncratic security selection?
Everybody will have a different answer to that question. And my perspective on it isn't necessarily the only one to consider. I mean, that's obvious, but for everything, but also, that is an open question. The reality is the world of risk managers, of sophisticated quant risk managers, will give the answer no. That it is extremely rare that you have, not that you don't have point in time or times where you totally crush it, but that the track record, if you look at aggregate at a lot of people taking factor bets, is pretty weak in terms of people demonstrating consistent skill. Whereas, not that everybody is, but there are a whole set of people who generate residual returns very consistently. Not every period, not every quarter, but generally pretty consistently and in a pretty amazing fashion. There is that exists, that return stream of residual, consistent, high sharp over time kind of P&L, where I think the risk purist view to answer that question is, there's a lot of people who are brilliant people who would answer this question this way. Some of them are people we've interviewed who would say no. There's obviously a whole set of other great investors who would say, what is this, academic mumbo jumbo? Like, I certainly called that macro and factor and piece of it correctly. And then there's there are plenty of middle grounds to be had for, again, tech investors who are like, hey, these are great stocks, and sure, it gets captured somewhat in the factors, and sure, I'm taking some factor bets, but hey, there's a lot of sort of secular kind of alpha to earned performance to be had by picking when to be long those things and when to be not, even if the data there's not a high enough end, so to speak, to kind of prove that point. So yeah, that's my wishy-washy answer.
Well, Chad, I would encourage you. We're going to do the same one next week with Rocky Caughran, who's the other core instructor in the program. He's coming from the quant investing stock selection side.
He'll say yes, right?
He'll say absolutely yes. I mean, that's the core of their business. And I think a lot of the framing on that argument is they're different. You can look at a couple of things. You can look at the valuation of a factor, right? And some of these firms are in print in bottom of 22 saying, hey, growth stocks look really cheap or growth stocks look really expensive. So you can look at, historical valuations over long time series. You can also look at valuation spreads within a factor. So when the value, spread of value stocks is very high, you're compensated heavily for taking a value bet. When spreads are tight, your valuation spreads are tight, you're not compensated heavily for taking a value bet. And so we can ask Rocky about the regime indicator, where there are certain regimes that some of these factors will, again, can you time them as accurately as you can time a company who covers earnings? Absolutely not. My general bias is, can you time markets? Not really, but at extremes, sometimes you can. Sometimes there are signals where it's like, hey, things are pretty cheap or things are pretty expensive. Factors, I think, is a little bit easier with some of these tools to time markets, but still very difficult. So I sympathize with the empirical view, just because there have been times where it's like, all right, this is a time to buy DREC, right? It's like April 2020, there were firms writing reports, time to buy DREC because the value spread is at a 50-year low, so you're heavily compensated for buying value stocks. So I think all of these are batting average things. These are 60-40 overlays, so nothing is a guarantee. There are no simple. So we will talk about factor timing. In the kind of pure quant world, you have the Cliff Asness AQR, like you can't time factors, no premium, no premium, just bet the value momentum factor. You have like a Rob Arnott research affiliates who they have ETFs who actually will have factor timing embedded into those ETFs, where they'll do kind of size up factors as they get cheaper. I think in
Yeah.
general, it's not like a huge alpha stream from timing factors, but you know.
I think it's a good thing about the course you put together, Brett, that you have people who have there's factors are being used in all kinds of ways. Like as I mentioned on the neutral side to kind of to some extent eliminate factor exposures, and on other perspectives are like, hey, here's the way to kind of time it or make the bet, and people have different answers to that question, as they do in almost every field of certainly investing, maybe everything. But there's a diversity of ways people kind of use it, and I think that's a good thing.
And I always like it too, is like, long-term momentum is persistent over 9 to 12 months, mean reverting over 24 to 36 months. So if momentum's had a couple good years and we're heading into, a new year, if momentum is expensive and has worked for a few years, like I might want to reevaluate my exposure. I might not want to be as long as a momentum factor as I had been in the prior year. So these are just kind of
And this,
ingredients in your portfolio strategy.
yeah, and this maybe reveals my bias on where I come out on the debate high level, but is if you had two managers, or if you had two return streams, one that was with high breadth in both cases, idiosyncratic returns that were strongly solidly consistently positive for 2 years in a row, and you had 2 years of consistently positive factor returns 2 years in a row. I think there is no question that for the same quantity, size or whatever, there's no question you would pick the residual return stream as a
Yes.
more
Yeah. Yeah. Yeah.
thing to bet on in the future. That basic framing is what is driving that secular kind of thing in some ways. But yeah.
Yeah, yeah, totally agree. Namely because you can lever it up, and there's orthogonal diversified risk in the IDEO as well too. You're not dealing with a momentum crash. Spencer from a family office seat. What's up, Spencer? Good to see your name. How do you recommend educating one's LP on this stuff? Not concerned on some performance because of factor exposure, et cetera. What do you recommend reading outside of Gappy's book? So
You beat me to it.
how do you educate the family?
You beat me to it. Yeah. Besides Gappy's book, the thing I like about Gappy's book is that it makes accessible a lot of academic literature, stuff that gets written in these papers and gets passed down just in conversation with people, right? Like there's plenty of other books, active portfolio management, which I think is what Gabby's title is alluding to, is kind of a reference to active portfolio management by Grinold and Kahn, is like the classic and was written in like the 90s, and basically says lots of Gabby's stuff. It says the same topics in 600 pages without the practical and performance overlays, and it's instead of again 175 pages, it's 600. But there's a whole set of books out there. Quantitative equity portfolio management is one that people look at, and it's one of the reasons I think Brett is doing a great job doing this course, which is, there's not a lot of great, there's a lot of great academic math literature on this stuff. And look, the whole quant world, again, if you're talking about the purest factors, not the sort of generate secular factors topic, but if you're talking about the sort of, market, the fundamental equity factor risk model way of looking at things, there's an industry around that. You could read Barra papers that they've put out, MSCI Barra papers that they've put out as well. But I think it's one of the reasons Brett has gotten the demand for the course is, people, a lot of that is housed within funds or kind of a little more just purely technical. And so it's one of the reasons, again, I like Gabby's book. So that's my short answer, is basically.
Yeah, there's not. I mean, we obviously use Gappy's book. It's suggested reading for the course. 75% of what we're going to walk through, there's no book on. There are some good free resources.
Exactly.
I mean, part of like, we don't want everything behind a paywall. You know how we do things. Like we want also, like, we're doing this to educate. And so as we build more content on this, we will open source good chunks of it. Another book I would add is on the factor investing side is Expected Returns by AQR quant. AQR does some interesting research on factor investing. Omar Cedar from Omega Point has their risk model vendor. He's been doing a podcast and some interesting pieces out. So there's kind of more, as Rich said, that Rich's LinkedIn is a good way to learn this. So there are some free snippets that you can piece together, without having to come. Or Spencer, just call me, man. Just call me. I'll come to Denver. We'll hang out. What else do we have?
A question of, is there anything analysts can draw from factor models to support idea generation, was a question that somebody asked here.
Yeah, yeah, that's I think that is, there's a couple angles to that. One is when you're an analyst within a factor constrained model, you're not going to be in the dashboard doing all these stats stuff, but you want to have an idea of how your pipeline fits into the risk model, to the point of, if you have one, excess beta short that your just book needs that short right now to stay within risk limits, you may want to be aware of that as you're thinking about potential new shorts, that I can look at the loadings of other stocks that I might approach on a fundamental basis and look at a few excess beta shorts. So if you can do that as an analyst, senior analyst, and be the person who solves that problem for when the high loading excess beta short needs to be covered, that will help you career-wise as an analyst. We'll talk through kind of like the alpha factors. I think in general, there's kind of like 4 core factors, like from a factor investing perspective. There's another question like what factors work. I think generally is relative consensus on, over a long period of time, 4 factors work. Value, intermediate momentum, 9 to 12 momentum, low vol, and quality, right? Over the last 20, 30 years, those 4 factors. They don't give you great returns. They're 1, 2, 3% return. In general, modern quant factor investors are really getting more than that by integrating the factors. So multi-factor models, which we won't dig into here, can enhance that. 1 or 2% return is not going to change your idea generation that much. If you're looking for a stock that can go up 20 or 30%, all of a sudden it's 21%. It's not really the foundational idea of your fundamental idea. Now, I've always used, and we'll dig deeply into this, using factor signals as idea generation tools, right? Again, back to the extremes. All the great investors I've worked with from an idea generation perspective, I was looking for the outliers, right? What are the outliers? What looks really cheap relative to its quality now? What has really underperformed but might mean revert? What it seems to be peak on peak. And so there are some factor lenses that can help you from that idea generation perspective. Empirical has a failure model where they talk about, quant selection models actually work, at least this brand of models work better on the short side than the long side. So they're really, really helpful in trying to identify stocks that can underperform, specifically around earnings prints, as there has been kind of deeply embedded in my process. And then we'll walk through kind of quant overlay approaches too, where it's like you can bring some of the principles of factor investing into fundamental investing too. So I think mostly for identifying the outliers, times when, hey, mid 2022, when growth stocks have been killed, but the growth factor looks really cheap. Maybe that's a sign to kind of like, lean into some growthier ideas. That's like a very basic use case for a factor lens.
There's some great questions here in the list here. We're not going to be able to get to them all, probably, unfortunately. But
go ahead and shoot anytime, Rich. I'm happy.
There's kind of a couple. I was trying to bucket a few of these questions into themes, but there was a couple of themes that people raised. One was like, how much of this is synthesizing a few people's questions? Like, is this predicted or backward looking? Is like one big topic. The couple of topics that people have asked about is like, is this backward looking or prediction based? And that's an important topic. The second topic that people kind of mentioned is, how do I use this as sort of a thematic investor more than somebody who's just trying to, really squeeze out ideo? There's a bunch of questions for me. Yeah, like whoever said, which is hilarious, like would Arcana flame me if I put every dollar into Nvidia? The answer is yes. So I love that. And then other people asking kind of just like successful vectors of uses of this. Like, what are the successful kind of uses of alt data people have seen? How do analysts use this to make money, as you just kind of covered a little bit? And then there's this aggregate question of like crowding, and do factor models kind of diminish the pool of video, which is a big topic. We probably can't cover all of that, but maybe to start with the first one, prediction versus backward looking. Again, I feel like sometimes we have to answer in both different frames of like factors as secular things to predict versus factors as they're used in fundamental equity factor risk models. But I'll really just focus on that because that's, again, the really prevalent in one category, at least, kind of factor or risk modeling. And so, yeah, they do ultimately make predictions. We'll talk a lot about more of that, I guess, in the course. But at a high level, like you use the data from the decomposition in the past to build up like how much of the aggregate risk in the book, and you sort of take that backward-looking data of decomposition to sort of gain a sort of predictive power on a forward-looking basis of what percentage of the book's risk exposures. First of all, like they make risk models generally make maybe 2 or 3 headline predictions. Like one, what is the volatility in the book that I'm taking? Like how much volatility will it have up and down? What's the standard deviation of its move? And 2, what percentage of that volatility is in factors versus ideo, and then under the hood of that within each factor, and then finally, like what's my exposure, my beta to each factor? Like if momentum factor is up 10, what would I be up? And so all of it is geared ultimately to making those 3 predictions. What's my vol? How much of that vol is in factors? And then where under the hood of that is that bet in factors? Like which factors am I exposed to? And so we probably don't have time to go into like the mechanics under the hood of that and the pitfalls, the negatives, the ways in which that's imperfect too. But the short answer is, risk models do actually at a portfolio level, again, single stock level is less accurate, but at a portfolio level, and again, they're not predicting whether that idiosyncratic or factor return is up or down. Although, even some commercial models will say, hey, this is a secularly strong factor, this is a secularly kind of underperforming factor. But predominantly, they're not making a prediction which direction the vol goes. It's just how much of the volatility is in single stock, idiosyncratic versus factor bets. And they do that very accurately. They extensively back test that. You extensively kind of look at, is this making an accurate prediction of that? And we'll talk about how that gets achieved and why that's the case. But they do make a pretty accurate assessment of portfolio level volatility and portfolio level split of that volatility between ideo and factor.
Yeah, I think there's in the factor investing side, there's a lot of discussion about factor persistence. I mean, one of the factors in the Fama French 3-factor model was size, which had efficacy until it didn't. And so it flipped. And so there is a debate on what's backward looking versus forward looking from a perspective. That's why I'm kind of a fan of this RoboCop model, where it's like the quant lens generally is backward looking, repeating patterns, statistically oriented. The fundamental view is forward looking, differentiated view of the future. Combining the two, to me, is the modern approach, kind of the highest sharp modern approach to combining both. And listen, this is a game of inches too. So these individual factors might only be 100 bips plus or minus. But if I'm looking at 2 portfolios, one that's quality, intermediate momentum, and one that's mid caps, high vol, well, I'm giving up probably 200 to 300 basis points with the mid cap high vol name relative to the high quality intermediate momentum name. And so that can be a difference when you're talking about beating an index or running a market neutral portfolio. And so factor leans within the context of your risk pie can move the needle at the portfolio level.
Yep. Yeah. And so, yeah, I mean, I think that's kind of a theme that runs through, I guess, this discussion for sure, which is, yeah, you have this sort of, there's all this kind of like, how do I use this thematically, the factor investing side of things and the factor risk modeling, and then the under the hood ways people even use that on offense, not defense. But there's kind of the factor risk piece and the factor investing piece. And of course, they have these intersections and places where people, bubble up ways in which A leads to B and vice versa. But so that's an important kind of theme here to like tease out between the two.
You want to talk about this one, Rich, of how do you build a linkage between thematic investment with factor model, and maybe just kind of highlight like the quant purist view of what a factor is versus is a theme a factor, and how can we think about thematic risk in a portfolio? It's very, very top of mind with the DeepSeek tape bomb from Monday.
Yeah, the risk quant view of the world, so to speak, or the risk manager view of the world, the risk factor modeler view of the world, is that you want to look for a factor. What is a factor? A factor is just anything that kind of moves, any source of systematic movement in a set of stocks. Basically, it's an aspect that is driving co-movement among stocks. But then like that could be a million things, right? And so the question is, what is a what are you using this for? And there's two buckets, really, at least. There's sort of risk factors and there are alpha factors. The set of risk factors, what has evolved to be like the best practice, is to look at things that are persistent, robust, have sort of both logic to them, at least at a high level, and have persistently had explanatory power. Meaning, if you looked at the value factor in 1980 and you looked at the value factor in 2025, it's a meaningful factor. It has high statistical significance. It has explanatory power. It contributes, contribution or marginal R squared to the model. That's kind of a great core factor, is being a value stock or a growth stock, having momentum. That isn't to say these are like predicting alpha or forward return, but it is definitely has explanatory power in explaining why stock A versus stock, group of stock A versus stocks being moved. So that in the world of risk, you want to look for stocks that have that persistence, or constantly there. And then the world changes. And so something that becomes such a dominant driver of performance, people are constantly asking the question, every model provider is constantly saying, what should I include? Like, should I include AI? Or should I include, different factors that are thematic, and maybe that theme turns into a permanent theme in some cases, right? And so, like, the risk world of modeling is trying to find those things that are consistently going to be sources of, like, tomorrow or the next day or 5 years from now, because you aren't trying to just sort of look at what recently moved stocks and then throw that into a risk model, because you'll sort of again, part of the job of the IDEO or fundamental investor is to find those things that are regime changes or secular shifts or things that are purely future oriented. So that's the world of, like, the risk purist would say, hey, let's look for things that are persistent, robust, have like long histories of track records. On the alpha factors, you have, first of all, every quant trying to find an alpha factor. Could be, 10 minutely, could be 10 daily, it could be over the course of many years, as some of the, like, AQR and other kinds of factors try to be, which is, you're looking for, it could be relevant for a day, it could be relevant for 10 years. And so there's kind of, again, that distinction of, if we're taking any source of systematic co-movement among parts of the market, what's the horizon that we care about that being persistent is going to be different if you're trying to set up this sort of clean accounting between systematic, because, again, take it back to the very beginning of this discussion. Why have factor risk management in the beginning? One of the reasons is benchmarking. One of the reasons is passive. One of the reasons is the freeness of, those kinds of things. And so if you're trying to say that, like, deep seek exposure is not going to be something that has a efficient mechanism of getting for free, or that has low, kind of risk premium, so to speak, in it. Whereas you are maybe going to be able to find that in other ways. So, in a more persistent factor, right? So again, that's on the risk side of things. That's why it's sort of, but on the alpha side of things, or on the sort of like, hey, what is the effect of, either some theme? Crowding is a huge topic we didn't really get to touch on much at all here, but what's an important kind of theme there too. So there's kind of this, like, what do I want to limit myself on from a risk standpoint, or cleanly separate out performance? Like, again, if it's an alpha factor, if it's deep seek exposure and you nailed that, or you nailed the relative exposures, you might not want that to be bucketed as just a factor bet. That was sort of an idea. That was, even if it was sort of a grouping of had a systematic principle underneath it, again, to the extent you want to do performance decomp through the lens of factor versus IDEO, you might want some just stability of what that means to be a factor, and then say, okay, some of these more systematic usages are in my idiosyncratic or alpha bucket, even if they have a systematic element. That's kind of, the way I would think about that.
That's great. That's great. And I'll plug the webinar next week too, where Rocky will really be our expert on, factor alpha, like factor harvesting too. So, we'll kind of have both angles of, I think, Rich and many of Rich's clients are constraining factors to isolate the IDEO, and the risk model is a tool to do that. And then there are other camps, like the quantamental world, supported by stock selection models, like the empirical model, where they're actually using a factor framework to outperform, to attempt to outperform by 1, 2, 3, 4, 5%. And so that is, I would say, the rich view of the world is more directly directly applicable to those who are using a risk model, which to his point is like becoming an increasing proportion of the group,
For
mostly
sure.
driven by the allocator demand to see decomp. Um, I think next week is more for those unconstrained investors that want to use a factor framework to outperform or minimize, limit, time factors or minimize big losers in those portfolio. That's really the rocky empirical lens. And so that's kind of the approach in this course of to cover kind of factor investing and factor risk management within the same umbrella, because there are some overlaps, right? If I have 70% IDEO, I still have 30% of my risk that's in factors, right? And so if I'm aiming to generate 3% as a market neutral PM, I'd rather have positive alpha factors in that
Absolutely.
30% than negative
Yeah.
alpha factors in that 30%.
Yeah. And people do think that way, at any of these places.
Yeah. All right. Well, I think as fast as we answer these questions, more come in. So I'll take that as a good sign that there's a lot of curiosity. I also want to be respectful of Rich's schedule, and respectful of my wife. It was a half day at Cochise Elementary, so she is expecting me home to aid in the parental duties. I will again remind we're going to do another one of these next week with Rocky. And listen, our mission, obviously, Fundamental Edge is a for-profit entity, right? We have an objective to build courses that, are high quality, high caliber, but we do really have Rich and I, a shared mission towards helping educate, whether people come to our course or not. And so many of these questions are great. Maybe these are things we will address in a tweet collectively or a LinkedIn post, or maybe we'll do a webinar again in 6 months. I don't know. We'll see. We'll see. So, we would hope to keep studying this stuff on our own. And I apologize, we can't get to all the other 31 questions, but please stay in touch with us one way or the other, and hopefully we can continue to kind of guide you through this process. And thanks so much for joining, Rich. This was
Sure. No, thanks for doing it. This was great.
This was really fun.
Thanks all.
Okay, thanks.